Okay, so another of these videos then, paper P5, here we go again. This time we're looking at financial performance. Probably the largest individual part of the syllabus is financial performance. So I think I've split this into three parts. When you have the three parts then split again into the tutorials and the questions, you're going to get 6 parts on this. There is no easy way to look at this. This is going to be in your exam. Once again, like everything else within paper P5, all of the answers will be given you. So if you looked at the June 2015 exam, everything that you needed there was actually done for you. Calculations, the works. It's all about taking a point, using some sort of structure that you put in these points, and then when you have the points, expanding them and getting the marks. If you can do that, you're going to pass. There's nothing new in this. Once again, if you're going to fail, the way that you'll know you're going to fail before you sit the exam is you'll be at home going, there's the question, oh look, and there's the answer, oh, and I knew all of it, because you know what, you already know all of it. Why even bother to pick up the book? It's all about structure and getting it down in a way that the examiner wants. You've heard this so many times, you're so bored of it now. Good, practice that structure. I'm going to give you a whole load of structures in this class, then we'll look at exam questions in the second part. Okay, so this is all fairly straightforward. Remember what we're looking at. We're looking at this idea of measuring the performance of organizations. So Peter Drucker said that there should be, Peter Drucker is one of these American guys who writes all of these theories in universities. Peter Drucker said that a profit-making organization, so we're looking at a commercial organization now. A commercial organization should have objectives which are based around 7 different areas. And there are the areas there. So market standing, so this idea of market reputation, innovation, a name for innovation, productivity, so we should be looking to have some targets that are based around the productivity and efficiency of the organization. Physical and financial resources, so the organization should have some objectives based around, if it's an asset-based company, about the levels of assets that it should have and how it should secure those assets, how often it should replace them, and so on. And the same for finance, and what kind of policies we should have in terms of collecting our debts. If we're a bank, obviously, in terms of safeguarding our money. We should have some objectives based around profitability, so what levels of profitability are we making, manager worker performance, and final public responsibility. So just get that clear in your head. Peter Drucker said that an organization, which is a commercial organization, should have objectives, and it should have them in those 7 fields. And as far as you're concerned for P5, that's all he's saying. You don't need to scratch any deeper. Where you're going to use this thing in the exam, therefore, is we're going to talk about assessing the objectives of an organization. Now, be careful, because this is where your examiner is really, really cunning. He writes, assess the objectives of the organization. And what students inevitably do is they assess the organization itself, not the objectives. So we have to talk about the objectives itself. Why is this good for you? You've got 7 little headings. So the organization should have some market standing. So what's our reputation? Do we have a reputation for good quality? Are we known for being a little bit dodgy, a slow payer? Innovation, do we have new products, or are we still producing square wheels? Productivity, and so on and so forth. Right, so as far as the exam goes, this is 7 headings, and we use them to assess the objectives of an organization. Within that framework, you will be given information about the organization. You then need to pick it up and say the company has a poor quality reputation. So your heading is market standing. Your point from the question will be poor market standing, and we expand that to say, well, we should have an objective to improve that, to improve our reputation, to improve our quality, because this will lead us in the long term to greater levels of productivity, will enable us to enter into the supply chains of our customers, because they will trust us, and so on and so forth. Right, I hope that's clear. All you need to know is that Drucker said that commercial organizations should have objectives based around these 7 things. In the exam all the time, and it's a beautiful little structure for you there. Right, so on the last slide we looked at Peter Drucker, and all Peter Drucker was saying is that organizations should have objectives, and he gave you some headings. Now on this slide, all we're saying now is we are looking at ways of measuring growth. I don't have a name that goes with this, maybe this is Peter Drucker as well. Please notice the key thing here is that measuring growth, we have financial measures, and we have non-financial measures. So measuring growth, you've got 7 little headings again. Try and learn them if you can. If you can't, try and learn as many. Once again, what are we going to use them for? We're going to use them for structure. So therefore, we've already seen a question now. I think it was Lincoln and Lincoln Advertising. So therefore, in the financial areas, we would look at profitability, we would look at revenue, we would look at return on investment. A return on investment, in my opinion, isn't great for measuring growth, but growth in profitability, growth in revenue, and growth in cash flow certainly are. Often when companies are growing very fast, you see that cash flow is negative as well because they need all of the cash to invest in their business. But measuring growth, please notice you've got financial and non-financial. So here we've got market share, number of employees, number of products. You may find when you look at an individual question, because these things come up all the time, that there's other things in the question as well. Right, I'm not going to explain this. You look in the textbook, they're all in there. If you don't know what they are, really, paper P5, you should. What are we using this for? It's a structure, it's a series of headings. It's important that you have financial and that you have non-financial, unless the question specifically says just use one or the other. Please remember them for the exam. They give your answer structure, okay? And you can add and take away as you see fit. See something there you don't like or it's not relevant for the question? Delete it. Something else that you think is relevant, put it in. It's your answer. It'll make it more relevant. Okay, so my nice little Smart Art balloon measure here shows a number of measures. Now look at these things. These are measures of long-term value according to this. So return on capital employed is a percentage ratio of what kind of profit are we making based on our capital. Don't worry if you don't get how to do the calculations. I'm going to go through most of these. Afterwards. So this is just the opening slide that lists them. And it's quite pretty, I think, with all those colours. You've got return on capital employed, and you should know what these are by now. Return on capital employed, which is your profit divided by your amount of capital, which is measured in various ways. Earnings per share, hugely important for the stock market, and we have accounting standards, so it's IS 33, is that right? Something like that? No doubt someone will write in and tell me I got it wrong. So you have earnings per share, which is your amount of profit divided by a number of shares, and that will give you a function of the share price, so obviously relevant for shareholders. The greater as well the multiplier is, so if you're the greater the value of the share in relation to the earnings, the greater the stock market thinks your company is going to grow in the future. Earnings before interest, tax, and whatever those other things are in this one, EBITDA is some measure that someone somewhere has decided is important. It will give you the profit before taking into account any of the financing charges. That in itself is quite useful. I mean, I would prefer just to look at gross profit. If you have a supermarket, gross profit is what is profit are you making from buying an apple and selling that apple. Net profit will give you the profit after taking in all the admin charges. These are just variations on a theme. So EBITDA, we get these things that become fashionable. If you do things like CFA, you have to actually learn these wretched things. Ultimately, they tell you more or less the same as each other. Net present value tells you what, in absolute values, is the current value of some future project. So you have your cost at its present value and your future cash flows. Very, very useful because it looks at cash flows. Your big what if in real life is what's your discount rate. And the IRR is the same as your yield to maturity, so it actually calculates the discount rate at which you break even, and that of course in real life is your interest rate on a loan. So the IRR is very, very useful. For those of you who haven't done paper P4, the MIRR, which is the modified IRR, one of the problems with the IRR is that if you have a project, let's assume you have a project and that project is to dig coal out of the ground. What will happen if you're in a country like Scotland is you buy a piece of land and you buy some equipment. At that point you have a huge negative net present value. Coal in Scotland at the first seam, the first level, lies on top of the ground, so you just scrape it off the ground and sell it. Often what will happen is at that point you will hit a positive net present value. So in terms of your graph, you've gone from negative net present value up to positive. Then you have to stop and dig a hole in the ground to get to the second seam, which is under the ground. Doing that brings you back down to negative net present value. You then dig out the second seam, which will give you a second point. Every time you cross that line on the graph where the net present value is 0, you will get an IRR. What you have to do in real life, therefore, is smooth the cash flows. And that's all that all the modified IRR does, is it's just smoothing of cash flows. And smoothing the cash flows in that sense then will give you one IRR, which is mathematically valid. Have a look on my notes about paper P4 and you'll see that there's an explanation of the modified IRR there. Next one around is liquidity. Liquidity is usually used, particularly for an organisation, just to see whether it's going to continue or not. If you haven't got any money, you can't continue to trade. So, but liquidity, obviously, for the bank as well. Can you afford to repay your debts? And gearing ratio is more. Liquidity is basically a measure for the bank whether you can pay the interest, and you have interest cover for that as well. And gearing is a measure of your debt to equity, which is a measure of your risk of not being able to repay the capital in the future. But you should really know what all of those things are. The only one I think which is new at this paper is called EVA, and EVA has been trademarked by someone or other, and it's basically just some measure. In the good old days, we used to have a thing called free cash flow. This now seems to have been taken over by another of these American calculations that tells us nothing we didn't know already. But those are your measures anyway. You should know what they are before the exam. So just to go through all of these things in a little bit more depth now. Return on capital employed, as long as the figures are available. So we're just going to look at the advantages and disadvantages of each. What's going to happen to you is that you're going to have to calculate them for things like return on capital employed. As long as it's some form of profit against some form of capital, it's not desperately important how you do it, as long as you explain it. And in fact, the latest examiner's done the calculations for you. You do need to know what it tells you, though, and you do need to be able to talk about what it tells you. Usually the way it seems to be examined at paper P5 as well is that you are going to have 2 or 3 divisions and you have to compare those divisions. So you've already seen Lincoln and Lincoln, and have a look at Lincoln and Lincoln and look at the question, and you'll see there's a good example of what you can expect in the exam. The advantage is profit divided by capital as a percentage, so it's easy to calculate. The figures are available. They certainly will be in the exam, if not in real life. And it measures how well the organisation is using the funds provided. To be quite honest, it's a big question as to how useful it is. As companies go through the cycle of age, so you get a company that's 20 years old, what's shown in the capital section of the balance sheet is who knows what. It's the original offered capital 30 years ago, maybe plus some share premium. Okay, you've got some retained earnings over 30 years, but what the company's done with them, it just becomes too difficult to predict anything. My personal feeling is it's not fantastically useful. Having said that, if you've got 2 divisions together, you can say, well, this division has this amount of capital, this is what it's done with it. And certainly affecting the calculation is to take into account cash flows through investments can affect it. So you can do a thing where you just look at how much capital they've reinvested, and that's done in real life. For the exam, easy to calculate. If you're using it between 3 divisions in the same company, then it is relatively comparable, but it doesn't really give us that much information that's particularly useful because you don't really know what the capital is per se. And if one division is much older than another, it'll distort. So that's return on capital employed. Our next measure is earnings per share. Earnings per share, again, easy to calculate. For those of you who've done paper P2, I'm not sure you would agree with that. The figures are available. Calculations are defined in an accounting standard. It is. The great thing about earnings per share, of course, that it's considered to be so important for the stock market, because what happens in real life is that everybody bases the value of your shares on the PE ratio, and of course the PE ratio is a function of earnings per share, so it's phenomenally important in real life. In terms of a measure of shareholder value, there hasn't been very much research that's really been done over the years that that's been able to show that it's fantastically useful. But you know, for people in finance, for anyone in finance, they absolutely do understand what it is, where the numbers come from, and to be honest, it's no less useful than return on capital employed. Right, and once again, if you don't know how to calculate it, then go over and have a look at my paper F7 notes, and F7 will show you how to calculate it. I really don't think in the exam, though, that you're going to be asked to calculate it. I think the guy's going to give you the numbers. Right, so this is earnings before interest, tax, depreciation, earnings before interest, tax, and depreciation. It is supposedly to tell us how much the organisation has generated without taking into account financing. Depreciation is considered to be not current. So in other words, what we're really trying to do is we're trying to use this as a proxy for cash flow. I would have to say that for most organisations, if you're working inside them, or if you're looking at quoted organisations that are producing IFRS accounts, I totally fail to understand why we can't just take the cash flow. You have a cash flow statement there, so work off of that. However, I have to say, forgive me for this without wanting to sound particularly poisonous, but so many of these things seem to come out of the United States of America, and I have no understanding what it is that they prove. No doubt there is research from 3 universities that show how great this thing is. Right, what do you need to say in the exam? Well, you need to say that it's a cash flow proxy, it ignores taxation and interest because for some reason they separate the finance decision from other decisions in the organisation, and depreciation is not considered to be current. No, I suppose it's fair enough. I mean, you're just going back to a cash flow. It ignores working capital changes, which I think is very poor, and it also ignores the money that you've spent on fixed assets. So no fixed assets ever feature anyway, and you can get accounting distortions when you use provisions and so on. Right, I've got to be honest, there's nothing I could ever envisage I would ever use in real life, but if your examiner gives it to you in the exam, you need to know what it is. It's some form of stripped out form of profit and loss account, which is a proxy for cash flows. Right, the net present value, the second most examined topic in ACCA after ratio analysis. Right, notice this. Now, net present value has a strong correlation with shareholder value, and I really like that because that's what we're really interested in, isn't it, in general? Shareholder value considers the time value and the risk of money, and it uses cash flow. The disadvantages with it are it's difficult to understand for non-financial people. I'll give you an example. I decide that I think I ought to have a car for my employees, so I prepare a net present value calculation. I go to my boss and I say, look at this, Graham. It shows that if you buy me a motor car, then the value of your business will increase by £12,637.27. And the guy goes, oh, what the hell does that mean? Yep, and that's why. The second thing here is the assumptions are very broad, so your cost of borrowing or your discount rate is the same throughout. And it says as a disadvantage, net present value is often used for project appraisal, product or earnings per share for managers' bonuses. I have no idea what that means. It certainly is used for project appraisal. That's what it's designed for, and I don't think that's a disadvantage. So I've copied that from the textbook, but I don't think that's relevant here. Right, you should really know what the net present value is. Right, we did the net present value. The IRR is always taught alongside the net present value, and it kind of worries me a little bit because students always have this kind of feeling that they kind of they know what the IRR is, and then when you scratch the surface, they don't. When you're doing finance, so like CFA, you'll see that it's called yield to maturity, and the yield to maturity is what is the annual yield on a bond calculated over the life. It's exactly the same thing. So the IRR, the difference between the IRR and the net present value is that the IRR calculates a percentage. So what's your yield? So you invest 100, you get 110 back, therefore your yield is 10% because your gain is 10. Yeah, you've got 110 minus 100 cost gives you 10 of gain. You invested 100, all of this at current value, of course, so 10 over 100 is 10%. And that is your IRR. And that's how you calculate it. Now, the big disadvantage of this compared to the net present value is that if you invest £1 and get £1.20 back, that will give you a better decision, according to the IRR, than investing £10 million and getting 11 million back, because your gain is greater, because the IRR is a percentage, it's a ratio. So how much do I get back in relation to what I invested? Many financists will say, well, it's still better, because if you have limited amounts of cash to invest, you want to invest where you get the maximum yield. Yeah, fair enough, but let's go with the NPV being better. Right, that's the IRR. The modified IRR is simply this process of smoothing cash flows. If you have the situation where you invest money, you get a return, then you have to invest more money, you'll get your net present value going negative, positive, negative, positive. Every time it crosses that line where the net present value equals 0, you will get an IRR. So you'll get multiple IRRs. And that mathematically, that's absolutely correct. It's losing its convexivity, I believe the phrase is. Right, therefore the MIRR, the modified IRR, simply spreads the cash flow so that we only get one IRR. And you use it in situations where you have things like oil, gas, coal, and so on, where long-term projects, investment money, and so on and so forth. And that's what you do in real life. You spread the cash flows. Right, you should know the IRR. Once again, I don't think you're going to have to do that interpolation thing where you choose 2 points. I hope that if this comes up in the examiner will give it to you, but you need to be able to interpret it. Right, so next in our exciting list is liquidity ratios. Liquidity ratios in the short term measure our ability to pay our debts as they arise. So the current ratio, which is current assets to current liabilities, the ACID ratio, which is your current ratio, which are your current assets minus your stock minus your inventory, divided by your current liabilities, which is a more definite test, I suppose. Again, you should really know what these things are. Interest cover, how many times over can we pay our interest? Gearing, so that's our debt to equity, or some variant on that. And finally, your working capital management ratios. So how slowly are you paying your creditors? How fast is your stock turning over? And how quickly are you collecting your receivables? Right, you should know how to calculate all of those ratios, and you should know how to interpret them. We come back to this thing which counts for all of these things, earnings per share and all of the other ones that we've just talked about. Oh, I sound a bit vague tonight. No, I haven't even had a drink yet. I'm in an Abu Dhabi. It's dry, actually. The whole point of all of this is you're going to get 1 point for pointing out the number, 1 point for explaining it, and then 1 point for saying what it means and how we rectify it. So please don't forget that. Again, this is the antithesis of this thing. Even at the very, very base levels of ACCA, the examiners complain that students calculate ratios, put a number on a page, and then move on. It's so much more now. You just won't get anything for that if you do that paper P5. So you have to talk about what it means, and you have to open up a little bit. And the examiner will help you, one, in that he calculates the number for you normally, and secondly, the information is in the question. So take it from the question. Please get this right. So what this slide, number 11, thank God, almost there now, is saying is, so what do we actually use these things for? So these short-term performance measurements, what are those measurements actually used for? And we've got 4 things here that we're going to use these measurements for. One is working capital management, so managing our working capital, so therefore trying to reduce our levels of inventory to the lowest possible point when it's all manageable, to collecting our receivables faster and conceivably paying our creditors a little bit more slowly. So we get these performance measurements, and then from this we may be able to, depending on what we've got, derive the information to manage our working capital. That's the first thing. The second thing that we use these things for is control. And in the sense that you normally have here is that you'll have, I forgot what they call now, variances. So you'll have your variances, in Russia, if you don't speak Russian. So you'll have your variances, and then with your variances you will investigate why these variances are actually happening. So we have this sense of control. Short-term performance measurements also for determining rewards. So therefore, if you are head of the debt collection agency, how fast are you collecting in terms of company policy? Are you collecting the company's money fast enough? If you are a director, are your divisions performing properly, and so on and so forth. And the fourth thing is for assessing past performance. So we're looking at past decisions which have been made. Past performance isn't a good word, is it? So we look at the decisions that have been made in the past and we say, were these correct? So we're looking at these earnings per share, return on capital employed, and so on and so forth. And we're saying, right, well, we can use this information to control working capital. We will do some variance analysis for which will build up an element of control. We will give people bonuses or not give people bonuses, and we'll look and see how successful were we at making decisions in the past. So our final slide. But our final slide looks at ways in which we can reduce short-termism. Short-termism is generally considered to be bad because what's happening is that you're looking at making profits or achieving aims in the short term, and that generally is at the expense of long-term investment in the business. This comes up in the exam all the time, so you should have some kind of a structure in mind for this. But the first thing is that we use financial and non-financial measurements. Now, if you remember back to Hopwood and his styles, we talked about budget constraint, about accounting profit constraint, and then a broader range. So here you're looking at using a broader range. When I say a broader range of ways of judging the performance of individuals. When you start bringing in things like customer satisfaction, you normally have to invest for the longer term, and short-termism won't work. Switch from budget constrained style, it's more or less the same thing. Those two things go hand in hand. So we don't just look at people's ability to meet a budget. We say, okay, if you're going to go over budget, can you recover that? Can you show that that will be recovered in the future? Share options. Once people get share options, they start to think more about the longer term. You have shares in the company. And share options are usually granted between 3 and 7 years as well. So you get given an option now, but you can't exercise it and get the shares until 3 to 7 years down the line. Good way of focusing attention on the longer term. Bonuses. Bonuses are granted based on criteria which include not only short-term issues, so therefore we have a much broader range of issues that we can base our bonuses on. It ties into points 1 and 2, switch from a budget constrained style, use of financial and non-financial measures, but the point being is that there's a financial reward attached to these things. Net present value and IRR usually are related to project management, and they're usually projects on sort of 2 to 5 years from what you've seen in your exam studies. So therefore net present value and IRR give us this idea that the value of the firm will increase if we move into longer term projects, longer term investments. Right, reduce decentralization. This one's in the textbook, and it says that if you centralize all of your practices, then you will get much closer goal congruence. Right, that's what the textbook says. That's what your P5 textbook says. I'm not really sure I agree with that. In general, when you start getting head office making decisions for field offices, you tend to find that whilst they look logical on paper, they don't work in real life, and the people in the field offices know better. Okay, your textbook says reduce decentralization, so centralize as much as you can so you get functional decision making in relation to the longer term strategy. It's possible in theory. I'd be surprised if it worked in real life. And finally, use other value-based techniques, so more than NPV and IRR, other techniques which are based on the longer-term growth of the organisation. Right, okay, that is financial performance management. That's part 1. There will then be exam questions. There will then be part 2 with the exam questions and part 3 with the exam questions. This is a huge topic. It's going to be in your exam. I once again imagine you've sat through this class, if you've sat through the whole thing without winding forward, and you're thinking, but I haven't learned anything, Mark. Please tell me something new. I don't have anything new to tell you, and you don't need to know anything new. My job is to tell you how to get through the exam. Learn all of this stuff as a structure, with even just simple ratio analysis, the gross profit ratio. The guy's probably going to calculate it for you, but you must explain what it means and how it relates to the question. And that's what you're looking at with all of this stuff. Okay, thanks for staying with me. It's now really rather late. I think it's about 11 o'clock tonight now. I'm going to go and watch the football now. My football team won in the league for the first time this season, so good day today. Have fun studying, guys.